Welcome to our High Rock monthly video for January. I am Scott, and with me is Paul. And Paul is the founder of High Rock, which he started back in 2010. And he's also our portfolio manager. If you are interested in learning more about us, visit our website at highrockcapital.ca. Well, Paul, December was another good month for financial markets on the back of a really strong November. Interestingly, though, most financial markets basically just got back or didn't quite get back to where they were in the end of 2022. So markets clawed their way back throughout the year, mostly in the last 2 months of the year. Anything stand out to you that you want to talk about?
Well, we'll just perhaps say why. So the months of November and it really, quite frankly, started in October, but the U.S. Federal Reserve came across in some of their comments and statements that they sounded like they were going to do a so-called pivot, i.e. move from massive and aggressive rate hikes on their overnight lending rate to perhaps stopping, and not only stopping, the market started pricing in because the Federal Reserve officials started notifying the market that, yeah, they'd probably cut rates in 2024, and they might be more back-end loaded than front-end loaded, but it might be more like 3 rate cuts, and the market is pricing in that for sure. So I would just say one thing I wrote to our high yield investors in the monthly note for December was the Fed is the oil in the machine. When they start cutting rates, the U.S. economy's been doing pretty well, but it'll hum along quite well with rate cuts. It's great for the consumer after they've been through so much pain. So that reflects pretty much everything we see right now in the chart in front of us.
Yeah, and also, of course, the Bank of Canada in a similar situation, right?
And the ECB too, the European Central Bank. It's all three. And well, it'll happen through New Zealand, Australia. So goes the Fed, so goes all of them.
Right. So for our clients who have floating rate debt out there at I think prime is 7.2. Certainly there's some potential for relief on the horizon. So I think that's something to look positively at for 2024 for them. Let's continue to talk a little bit about how things have looked, because as I said, and this chart basically just tells us what that balanced ETF, the iShares balanced ETF that we follow, and compare to our own performance often, but how it's done, and specifically not just how it performed over the course of last year, because certainly 2022 was a very difficult year, but how it's performed over the last 3 years, and not only that, really on how other balanced portfolios have performed as well. So let's just look at what this slide here, and just for clarification, the Morningstar Global Neutral Balance category is over 500 different funds that they track, and so that gives us what we'll classify as the category average of returns over the last 3 years. And then what's really important, and we've highlighted in red here, is how that's impacted performance over the 3-year period. So what is that average annual return, total return over that period of time? So let's talk a bit about this performance, because there's has been a lot going on over the last 3 years. Following the pandemic shock of 2020, we've seen markets extremely volatile, up in 21, way down in 2022, and then back up in 2023. So how is this affecting a balanced portfolio? The news media, mutual fund salespeople, online brokers, they'll always focus on the more recent results, especially if they're good. But really, all they're trying to do is get the unsuspecting to do what they want, and that's chase historical returns and make sales of their portfolios. But what makes a standout portfolio manager is not just the most recent 1-year return, but the ability to mitigate the bad years and get back to growth more quickly. And that's what we do. That's what happened in 2022. So, for example, and you know, you can compare it to XBAL up here, the iShares Core Balanced ETF, which is a top performing balanced fund. So it's in what Morningstar would call its top quartile. So you can see, though, that even with good performances, double-digit performances to the upside in 2023 and 2021, a double-digit downside performance in 2022, and your 3-year total return is a little over 3.5% on average. If you have a portfolio that performed just a little less well in 2021, say 10%, and a little less well in 2023, say 9%, but only a negative return of only 7% in 2022, that portfolio would have got you closer to about 4% annual average return over 3 years. So two things. One is over 3 years, you're ahead because you mitigated the downside in 2022. And of course, by mitigating that downside, you probably slept better in 2022. So it's important to look at all of these numbers in a relatively in a relative way, and how is it impacting you? And as of course, we're always looking at longer term scenarios. So how does that impact you over the longer term? Paul, any comments?
Yeah, I actually have a few. That's a really good recap, Scott. I would say number one, chasing performance on a short-term basis, i.e. 1 year, is the road to hell is paved with that. We've seen it before, and our own clients have seen it over my career. You see it constantly. Number two is, I'm glad you're focusing on the 3-year return, and that in itself is even quite short. But we do need to focus on performance for sure. That's all we do, is try to manage and create strong risk-adjusted returns. But even if you're a young person, like 30, 40 years old, your time horizon is out to your 90. You've got 50, 60 years. If you're 60 years old, you've got 30-year time horizon. Focusing on 1 year, 2 year, 3 year, not so much. And the third thing I would focus on, which I just mentioned, is risk-adjusted returns. So you obviously want to have the highest return with the lowest amount of risk, and risk being defined as the standard deviation, or the volatility or variability of those returns. So you could go through this slide and look at some that have, really high, strong performance on the positive side, and really bad performance on the negative side. Not something you want to look for. You'd rather have a less volatility in those returns. Those are my 3 observations there, Scott.
Yeah, and thank you for that, because I think it's really important, as you do say, as you said, risk-adjusted returns. So how do we mitigate risk as best as we possibly can in those difficult years, so that we don't have as much catch-up to do in ensuing years, and we get back into that growth mode much more quickly than a more volatile situation. Now, again, everybody's portfolio is different. We really want you all, if you have any questions about your own portfolio, to make sure you call us, and we can talk about your portfolio in the context of how these other balanced portfolios have performed. And I think that's really important. And anybody who wants, and because everybody has a differently structured portfolio, it is important to understand the risk that you have and whether or not you're happy with that risk, and your performance. If you want to take more risk, then of course we want to talk about that with you as well. Okay, Paul, let's talk about special mandates. We've got a couple out there that a new one, and certainly the high yield that's done so well.
Yeah, high yield. First of all, no real change from the comment I made back in early December for the month of November. Those people had well, strong risk-adjusted returns without saying any more, and advertising performance. So it's gone really well. I would say a lot of that has been driven by a strong, large allocation to energy, high yield energy bonds that performed extremely well. And again, some of our private clients have some of those bonds in their portfolios, specifically in the tactical model. We did start our preferred share mandate. We were talking to some people in October. Unfortunately for us, that was kind of the bottom of the preferred share market. We had great idea, and our timing could have been about 2 weeks earlier. Nonetheless, that's gone really well. We had a very good November. We were able to buy into the market. Unfortunately, as I mentioned, everything was moving higher in November. And December preferred shares were sort of flat-ish, enabled us to continue to buy and build that portfolio up. And I still think there's some good opportunity in there too. But those are just two examples of the things that we do to add on and fill a hole in certain investors' overall portfolios. And I should mention too, Scott, even the preferred shares that, you know, our balanced clients, our private clients, have some of that exposure, which falls under the fixed income bucket model.
Yeah, and certainly it's been helpful in adding what we'll call necessarily non-correlated assets to a portfolio to give it some of that broader diversification that helps in negative years to mitigate the downside, and also potentially add growth in good years. And of course, we're always focused on the long term and your specific goals and targets. And as always, we want you to get in touch to have conversations around these. If they change, if you want updates, we're always available. And we can't emphasize enough how much we want to have these conversations with you and continue the dialogue in order to make sure that you are moving continuously towards your goals. I'll very quickly talk about global equity strategy. The economy may or may not end up in recession. That, in all likelihood, is built into what we see in equity prices. What we focus on is where there's value, where future-looking or forward-looking earnings tend to go. Normally, prior to the great quantitative easing that central banks undertook post-pandemic, it is earnings that tend to lead prices. And you can see that in this chart here in the earlier years. Currently, we're back to a situation where earnings and prices are more in line with each other, although at this juncture in equity market prices, they are now slightly ahead of earnings. We think that makes them look expensive, so we'll be cautious about buying anything at these current levels, but we continue to monitor how the equity markets are trading and continue to look for value. Paul, do you want to talk about the tactical model?
Yeah, a couple things in the tactical model. In December, we sold a position in Baytex Energy bonds, which we look at as equity. We already own Baytex stock, which is equity. So that was more of a shorter term trade. And part of the reason why we sold that was, number one, the bonds popped up in price quite well over November, December, as the overall bond market rallied strongly, as we talked about earlier, due to the Fed's the Federal Reserve's so-called pivot to lower rates. But the other reason why we didn't add in another energy stock, and it was more of a, not a core holding, but a shorter term play, we bought some Cenovus, which is another large, well, a large energy producer in Canada and the US. So it was more of a, to be honest, more of a technical trade, just given what's going on in the Middle East, and seems to be a lot of terrorism going on with shipping routes. So that was part of our thinking there. The third thing, change in the tactical model, was which came out a while ago, but it actually transacted in December. Yellow Media, which is a core long holding we've held in that stock for quite some time. This was the second time the company did a plan of arrangement, which is a legal term, where they bought back stock from every single holder on a pro rata basis of roughly 1/3. And it's quite unfortunate. The company continues to build cash and do well, but it's really just not being reflected in the stock price. So this is not one we're going to add back or go buy, because every time they come out to buy the stock back on a plan of arrangement, they've done it twice now in the past year and a bit. It's quite frankly at the market. There's no premium being built into it. So that's it for the tactical model, Scott. Fixed income, we've talked about this so-called Federal Reserve pivot to lower rates. So every sector in that pie chart improved, and some more dramatically than others, specifically the ones that were hit the most. So government bonds, which are considered 100% interest rate risk or exposure, rallied the most. And here's a great example. You probably have all heard people, and certainly Scott and I have, and Diane, heard clients and prospects say, oh, I'd rather just buy a GIC at 4 or 5% or whatever it is, depending on when and how long you go out, whether it's 1 year or 5 years. But here's something interesting that hit up. So what I've got here on this chart is the Government of Canada current 5-year bond. And people, you could have bought this in early October when it was yielding about 4.45%. You can see right in the top middle. And if you held it to the end of the year, it would have gone to 3.17% yield. And that alone, if you look sort of in the middle left, and there's a red circle, just over those 3 months, that would have produced about a 6.7% return over the 3 months. If you annualize that, including the interest income that you would have made holding that bond, you would have had a 28% return annualized. So what I would take away from that is everybody was talking, I don't want to own bonds, I'd rather just own a GIC. Well, too many people said that, and too many people were short bonds, and here's what happened. It was a massive rally over that 3-month period. Number one. And number two, you really need to think about that, because if you bought a 5-year GIC at 5 or 5.5% back in early October, you're locked in for 5 years. Locked in. All you can earn is 5 or 5.5% annually. That's it. You get no more, and you're locked in. If you bought a bond, now mind you, the timing would have had to have been perfect. But if you buy a bond, you can sell it multiple times a day if you want. It's liquid, like water. Anyway, just a observation.
Well, and also just to add on to that, GIC is the income is all you're getting. You're not getting any price appreciation, or you're just getting income, and it's taxable at your marginal tax rate. Whereas with a bond, if you were buying that bond at a discount, that the difference between where you purchase that bond and where it matures is going to be a capital gain. And that capital gain is taxed at half of what your marginal income tax rate is. So there's a taxable benefit to having purchased the bond as well, right?
Yeah, that's a very good point. As you can see, that bond was bought, to sub $95 and sold, would have been sold over par. So you had, 5.5 points roughly of capital gains over a 3-month period. So very good point. Plus, maybe it's not a huge thing, certainly over a 3-month period, but when you buy a GIC, do know that you are taking credit risk of that bank. Now, is it possible that a Canadian bank files for protection, bankruptcy? Yeah, it's possible. Is it probable over a 3-month period? Very unlikely, but nonetheless, it is credit risk. I'd rather take the government of Canada's credit risk, although I could argue against that at some points.
All right, thanks. So, and Happy New Year, everybody. It is a new year, so let's talk about a couple of things that are important for your wealth forecasting. Absolutely, if you can, everybody should be contributing to their TFSA. That money is money that will grow until it becomes your part of your estate, and even then it will transfer tax-free to your beneficiaries. So that money grows tax-free. So everybody should always and everywhere be building their TFSAs as best as, and if possible, that they can. RSPs, that again is something that we can have a conversation with around your tax circumstances, whether or not it makes sense to make a full RSP contribution or not, whether you need that deduction. Again, always happy to have those conversations in conjunction with your tax specialist. So please make sure for all of these that you get in touch with us. Now, new to last year was the first time home savings account. You're allowed to contribute 8,000, which is deductible. If you did not contribute in 2023, you have carry forward of that amount into 2024. So you have a $16,000 contribution room. Again, if you want to know more about this, go to the Canada Revenue website and have a look to see if you qualify. Again, it's for first-time home buyers. And again, there is a lifetime limit, but there is some tax deductions involved in your contributions. So always worth exploring. And that's all for today.
Scott,
again, as I said, Happy New Year, everybody. Certainly wishing you all the best for 2024. And we'll be back again in the beginning of February.
Scott, one other administrative thing as well. Likely Diane, but High Rock will be sending out a lot of documentation that requires updating, whether for account information. And this is extremely important for us. It's a pain in the neck. We realize we do use DocuSign to make it less of a pain in the neck, but it's extremely important that we get documentation updates from you, because it's a compliance requirement from the Ontario Securities Commission, our regulator. So we need to get these things done in a timely fashion. So please, when Diane sends them, do them ASAP.
Yeah, and I'll just back you up on that and say our world gets very complicated if the Ontario Securities Commission audits us and we're offside on not having proper updated documentation. So it is very important to look after these matters. All right. So once again, thanks for tuning in. We'll be back in February to give you more of a hard time about documentation and among other things. Until then, take care.